Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Novo Nordisk.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and we have a really fascinating setup for you today.
We absolutely do. Because if you've been tracking the broader financial markets lately, or honestly just watching where the sheer volume of institutional capital is flowing, you already know the healthcare sector is undergoing this massive structural rotation.
Oh, totally.
And sitting right at the absolute epicenter of that movement is one dominant player, Novo Nordisk.
Right. And we are looking at a company that hasn't just, introduced a new drug.
Yeah.
They've fundamentally re-architected the global approach to metabolic health.
Yeah.
But the financial and operational mechanics happening under the hood right now are, well, they're far more complex than the mainstream narrative suggests.
Exactly. We've pulled together a ton of data for you today. We're integrating heavy quantitative financial models, real-time market sentiment trackers, technical volume charts, and the latest institutional flow data.
Because our mission for you today is to strip away the noise. We want to look past those flashy consumer headlines about weight loss miracles to understand the actual granular machinery of this GLP-1 empire.
Yeah, because right now, there is a fierce multi-billion-dollar debate raging across trading desks. Is the recent, honestly pretty violent downward repricing of their stock a glaring fundamental warning sign? Or are we staring at a generational capital allocation opportunity?
That is the big question.
Okay, let's unpack this, because to accurately project where Novo Nordisk is heading into the next decade, we first have to quantify the sheer, almost unprecedented scale of their current market capture. I was looking through the revenue models, and the concentration here is staggering.
It's massive.
Their diabetes and obesity care segment isn't just their flagship anymore. It now accounts for over 90% of their total global revenue.
Yeah, the top-line numbers are almost operating on a different physical scale than the rest of the sector. When you look at the 2025 projections, we are seeing sales figures hitting 309.1 billion Danish kroner. Right. That represents a 6% bump in Danish kroner and an even more aggressive 10% jump when you adjust for constant exchange rates. But the metric that truly separates them from their peers is the profitability profile. Historically, they have maintained profit margins north of 80%.
Which is wild. I mean, an 80% margin is something you'd expect from a pure-play software company distributing digital code.
Yeah.
Not a heavy manufacturing firm that produces sterile, cold storage biologic injectables.
What's fascinating here is the sudden, violent collision between that peak operational dominance and their forward-looking narrative. You have this absolute fortress of a balance sheet churning out software-level margins, and then management steps up and issues their 2026 guidance.
And that's where the plot twists.
Completely. Instead of projecting a continuation of that hypergrowth, Novo forecasts a 5 to 13% contraction in both sales and operating profit for 2026.
I remember watching the tape when that guidance dropped. It just feels completely counterintuitive to the reality on the ground. You have literal wait lists for these drugs. You have a global supply shortage because consumer demand is so rabid. How does a company with an effective monopoly on the most sought-after molecule on Earth actively forecast a revenue contraction?
You have to look at the two distinct macro forces squeezing their balance sheet right now. First, the U.S. pricing environment is becoming outright hostile.
Right.
The pressure from pharmacy benefit managers, compounded by political scrutiny over drug pricing parity, is forcing Novo to offer significantly steeper net pricing discounts just to maintain their formulary positioning.
So they're taking a hit on the net price just to stay on the preferred insurance tiers.
Exactly. And second, and arguably more impactful, is their capital expenditure cycle. They are currently executing one of the most aggressive CapEx buildouts in modern pharmaceutical history. They are intentionally sacrificing the 2026 operating margin to rapidly physically scale their global manufacturing footprint.
And Wall Street famously hates waiting.
Oh, they despise it.
The market's reaction to that 2026 guidance was immediate and brutal. Shares plunged 18% almost overnight. And the data points out that the bleeding was accelerated by a poorly timed wave of FDA warning letters regarding some of their manufacturing facilities.
The institutional panic was palpable. If you look at the technical volume profiles during that 18% drawdown, analysts are flagging the price action as classic capitulation. The volume spikes indicate a total flush-out of weak hands and late-stage momentum buyers who were just banking on uninterrupted quarter-over-quarter beats.
Just a total washout.
But the technical models we're reviewing also frame this within a much wider lens. Even factoring in this violent haircut, the stock is still sitting on a 112% gain over a 5-year horizon.
That's incredible resilience.
It is, and the technical consensus suggests this recent consolidation near the lows isn't the top of the bubble popping, but rather the formation of a massive basing pattern. The smart money is viewing this as a structural reset before the next macro leg up.
Let's test that smart money theory, because defending a moat with an 80% margin profile is incredibly expensive when the rest of the industry smells blood. Novo is not operating in a vacuum here.
Definitely not.
Eli Lilly is launching an all-out assault on their market share with tirzepatide, which they're rolling out as Zepbound. We know Lilly's molecule is highly effective. So how does Novo defend its territory when a competitor with equally deep pockets shows up?
They pivot from a purely scientific defense to an infrastructure defense. This is where we have to critically examine the $11.7 billion acquisition of Catalent. Historically, the pharmaceutical playbook is to keep your R&D in-house, but outsource the actual physical filling and finishing of the pens to third-party contract manufacturing organizations, or CMOs, like Catalent.
But relying on a third-party CMO when you are in a literal arms race for supply seems like a massive strategic vulnerability.
It is the ultimate vulnerability. The gating factor in the GLP-1 war isn't patient demand, it's sterile fill-finish capacity. By dropping nearly $12 billion to acquire Catalent outright, Novo Nordisk is forcefully taking control of their own supply chain.
That makes sense.
But we need to look at the secondary effects of this move. Yes, they secure their own manufacturing capacity, but they also effectively remove a massive chunk of global CMO capacity from the open market.
Oh, wow.
Right. They are functionally starving emerging competitors who rely on Catalent from scaling their own competing therapies.
That is ruthless.
Yeah.
But it also heavily validates the bear case regarding their margins, doesn't it? You don't absorb a massive capital-intensive, lower-margin manufacturing operation like Catalent without it severely diluting that pristine 80% margin profile we talked about earlier.
It is a deliberate margin dilution, yes. Management has clearly calculated that owning the means of production and guaranteeing supply is worth the structural hit to their short-term operating margins. And Catalent is really just one piece of the capital deployment strategy. Look at how they're moving into adjacent therapeutic areas with the $4.7 billion acquisition of Acro Therapeutics.
The Acro deal is fascinating because it signals a total narrative shift. They aren't just a diabetes or obesity company anymore. Acro is a pure-play bet on MHH, metabolic dysfunction-associated steatohepatitis.
That acquisition reveals the true architecture of Novo's 10-year plan. The liver is the biological nexus of metabolic syndrome. By bringing Akera's pipeline in-house, Novo is executing a strategy to totally monopolize the patient journey.
From start to finish.
Exactly. A patient enters the ecosystem for glycemic control, stays for the obesity management, and as those conditions inevitably interact with liver function, kidney stress, or cardiovascular health, Novo ensures they are the provider at every single node of that downstream progression.
Here's where it gets really interesting, though. We can talk about injectable pens and CMO acquisitions all day, but the most aggressive catalyst we're seeing, the variable that completely redefines their total addressable market, is the transition away from the needle entirely, the oral revolution.
The data coming out on oral Wegovy and Rybelsus is staggering. Injectable biologics have a hard, immovable ceiling. You have an enormous segment of the global population dealing with needle phobia, and beyond that, the cold chain logistics required to ship temperature-sensitive pens across the globe are a massive friction point.
Absolutely.
Formulating a complex GLP-1 peptide into a highly bioavailable, shelf-stable daily pill is a monumental leap.
And the market adoption proves it. The latest figures show oral Wegovy has already crossed the 100,000 U.S. user threshold. Some of the industry analysts we're tracking are casually referring to this as the most successful pharma launch in history.
Because it fundamentally changes the prescribing friction. A primary care physician is infinitely more comfortable writing a script for a daily pill than walking a patient through the mechanics of self-administering an auto-injector. Novo knows exactly the kind of leverage they have here, which brings us to their marketing capitalization.
Right. The internal models show Novo is loading up a $500 million U.S. ad blitz, explicitly scheduled for the first half of 2025. $500 million in just 6 months. That isn't just marketing. That is an attempt to entirely rewrite consumer behavior before Lilly can formulate an oral response.
It's a saturation campaign designed to establish immediate brand ubiquity. They want patients walking into clinics demanding the pill by name, but they are also reinforcing that consumer push with aggressive clinical label expansions.
Like what?
Well, they're currently fast-tracking regulatory approvals to explicitly label semaglutide for CKD, chronic kidney disease, and HFpEF, which is a notoriously difficult-to-manage form of heart failure.
The pipeline data also flags some deep-value speculative plays that are flying under the radar. There is heavy institutional chatter regarding the accelerated phase 3 trials for zenalgomtide, or amycretin.
Zenagamtide is the counteroffensive to Eli Lilly. The current generation of GLP-1s are single receptor agonists. The next frontier involves targeting multiple hormone receptors simultaneously to drive even more aggressive metabolic optimization.
Ah, I see.
The fact that Novo is accelerating phase 3 trials for multi-agonists while still trying to meet demand for their current generation shows they are not resting on their laurels. They're trying to cannibalize their own product before a competitor does it for them.
Okay, let's pivot from the pipeline to the actual market psychology. How are the institutions actively trading this right now? The quantitative sentiment scoring and the real-time news flow analysis paint a surprisingly resilient picture. It's skewing heavily neutral to bullish. A great example of this is the recent resolution of their feud with the telehealth platform Hims.
We have to view the HIMSS resolution purely through the lens of strategic distribution. For the past year, Novo engaged in a highly aggressive legal and PR campaign against compounding pharmacies and telehealth platforms like Hims that were distributing genericized versions of semaglutide.
Right. It was getting pretty heated.
Very. So the fact that they suddenly pivoted from litigation to a formalized partnership is incredibly telling.
It honestly feels like a capitulation on Novo's part.
Yeah.
Why fight a war you can't win when you can just absorb the enemy's distribution network?
Exactly. They recognize that Hims controls a massive, highly engaged, direct-to-consumer digital infrastructure. By partnering, Novo instantly neutralizes a major compounding threat and seamlessly integrates millions of digitally native patients directly into their legitimate supply chain.
That's a brilliant pivot.
Furthermore, the broader industry news flow is breaking in Novo's favor. Roche recently released their highly anticipated clinical trial data for their own GLP-1 candidate, and the efficacy markers are notably trailing Novo's established baseline.
That provides a huge buffer for them. But the most compelling piece of institutional flow data jumped out at me. On March 5th, 2026, Karen Firestone, who runs a massive institutional portfolio, went live on CNBC and explicitly announced she was, quote-unquote, cluster buying Novo Nordisk following the dip.
If we connect this to the bigger picture, cluster buying is one of the highest conviction signals retail investors can leverage. When you see a highly respected institutional manager aggressively accumulating blocks of shares in a condensed time frame, specifically into the teeth of an 18% drawdown, it broadcasts a very clear message.
And that message is?
The institutional modeling suggests that the broader market has fundamentally mispriced the 2026 guidance dip. It's the smart money stepping in to provide a floor.
And it isn't just bottom-up stock picking. The macroeconomic tailwinds are forcefully pushing capital into the sector. The data outlines a major sector rotation currently underway.
We are operating in a highly complex, slightly adversarial macro environment. We have persistent war-related inflation metrics causing wild swings in the CPI data. When inflation proves sticky and geopolitical tensions rise, institutional capital traditionally flees high beta tech and rotates into defensive, cash flow-rich behemoths.
So healthcare becomes the play.
Healthcare, and specifically a monopoly-esque player like Novo, becomes a primary safe haven.
Add the anticipated interest rate cuts to the mix, and you supercharge the institutional appetite. But the most vital macro shift is happening within the insurance sector itself.
That is the true tipping point. For years, insurance providers pushed back on covering GLP-1s strictly for weight loss, classifying it as a lifestyle treatment. But as Novo secures those label expansions for severe cardiovascular and renal outcomes, the actuarial math flips.
How so?
Insurance companies are realizing that fronting the cost for a daily Rybelsus pill is exponentially cheaper than covering the fallout of a patient's open-heart surgery or chronic dialysis. That systemic capitulation by insurers completely de-risks the revenue pipeline.
I need to play devil's advocate here, though. We've painted a highly compelling picture of dominance, but there is a very sobering bear case out there. And if you are going to allocate capital, you have to look the bear in the eye.
Fair point.
The skeptics look at that 5 to 13% projected contraction in 2026 and see a fundamental broken growth thesis. They argue the U.S. pricing discounts are only going to accelerate as political pressure mounts. They point to the inevitable patent cliffs approaching later in the decade. They highlight that the Catalent and Acro acquisitions will permanently degrade operating margins.
Those are all valid concerns.
And perhaps most alarmingly, they point to the recent clinical data from the CagriSema trials, which reportedly missed several key endpoints when stacked up head-to-head against Eli Lilly's Zepbound.
It is a formidable list of headwinds. But this raises an important question, and it's the core of the final investment thesis we're tracking. Have those specific quantifiable risks already been priced into the equity during that massive 18% flush?
That is the multi-billion-dollar question.
The analytical consensus argues yes. When you run the discounted cash flow models and weigh the CagriSema miss and the margin degradation against the sheer scale of the vertical integration, the structural pivot to the oral pipeline, and the MSH expansion, the risk-reward matrix skews heavily positive.
So the bulls are still in control.
Yeah, the aggregated models assign Novo Nordisk a final bullish score of 8 out of 10.
So what does this all mean? If we have to distill this massive web of clinical data, supply chain logistics, and macroeconomics into a core elevator pitch for you, it comes down to this. The foundation of their GLP-1 empire is completely intact.
Unquestionably.
The explosive, paradigm-shifting launch of oral Wegovy fundamentally breaks the total addressable market wide open, pulling in millions of patients who would never consider it an injection. The aggressive, capital-heavy acquisition of Catalent effectively starves their competitors of manufacturing oxygen.
And when you overlay the institutional accumulation we're seeing at these capitulation lows, the definitive takeaway from the data is that Novo Nordisk is a formidable multi-year hold as we approach these critical upcoming pipeline readouts.
It really is the ultimate exercise in deferred gratification. Management is willingly taking a localized hit to their 2026 optics in order to permanently cement a global monopoly on metabolic and cardiovascular health for the next decade.
Exactly. They're playing the long game.
We have covered an incredible amount of Tehran today, moving from the intricacies of Danish kroner revenue models to supply chain warfare and diving deep into institutional trading psychology. Thank you so much for joining us on this rigorous journey through Novo Nordisk's financial architecture. It is dense material, but mastering these underlying mechanics is what separates reactive panic selling from truly informed strategic analysis.
And as you wrap up, I want to leave you with a final, broader thought to consider, one that extends way beyond the balance sheet.
Let's hear it.
As titans like Novo Nordisk successfully migrate the treatment of severe obesity and complex cardiovascular disease from the sterile, medicalized environment of cold storage injections into the frictionless, everyday routine of just taking a pill with your morning coffee, how is that unprecedented ease of access going to fundamentally rewire the economics of the entire global food, beverage, and fitness industries?
Oh, that is exactly the kind of second-order effect that makes analyzing these markets so endlessly compelling. Keep asking those difficult questions, keep challenging the consensus data, and most importantly, keep learning. We will be right here waiting for you next time.